Imagine you have a pizzeria, okay? Now you think this pizzeria is doing so well that it's turning a profit every month. But there's one catch. You're not the sole owner. You shared this pizzeria with some friends who contributed money along with you to open the business. Then at the end of the month, after paying everything, employees, ingredients, electricity, water, you have money left over. What do? Each of you gets a share of that profit because you're all owners, right? What you are doing is called share the profits. In the investment world, this is called dividing. When you buy a share in a company like Coca-Cola, McDonald's, or Apple, you become a shareholder. And if that company makes a profit, it may pay you a portion of that money as a thank you for owning a piece of its stock. It's as if she were saying, "Thank you for believing in us. Here's your share." Then, dividend is this, a payment you receive just for owning part of the company. You don't need to sell anything or do anything. Just hold your shares and wait. And the coolest thing, the more shares you hold, the more slices of the pizza you get. And the longer you hold those shares, the more pizza arrives on your plate. So now that you understand what dividends are, like earning a share of the profits just for being a partner in a company, the question becomes, okay, but why is this so special? Let me tell you a quick story. Imagine Sophia. She's 21 years old, lives in the US, works part-time at a coffee shop, and has only a little spare change each month, like $10 a week. Instead of spending it on another milkshake, she starts buying dividend-paying stocks. She doesn't know much about the stock market yet, but she's heard that there are good companies that pay you a little money just for owning their shares. And the best part, she activates something called automatic reinvestment, which is like putting the coins back in the safe. First month, earn pennies. Second month, earn a few extra cents. But after a few years, the dividends she reinvested began to generate more dividends on their own, like a snowball that gets bigger and faster the more it rolls. This effect even has a fancy name, compound interest with passive income. In other words, you no longer depend solely on your salary. Money starts working for you every single month. And the most incredible thing? Whether the market is going up or down, you're still making a little money. It's like planting a tree that bears fruit every month. You don't need to sell the tree, just pick the fruit. Don't miss the tips that will transform your investing. Click subscribe and activate the bell to be the first to know. That's why investing in dividends isn't just about making money, it's about gaining freedom. Freedom of time, stress, and over time, even financial freedom. Now imagine this here with me. You're in the backyard, it's winter, and a fresh snow has just fallen. You grab a handful, make a little ball, and start rolling it on the ground. At first, the ball is small and a little slow, right? But the more you roll, the more snow sticks to it. And suddenly, it's huge, heavy, and almost rolling on its own. This is exactly how dividends work over time. Let's think very simply. You buy shares in a good company. That company pays you, say, $10 in dividends per month. Instead of spending that money, you reinvest it. You buy more shares. Next month, you don't just have the initial shares. Now it has more actions, and that means you receive more dividends. Then you reinvest again. And the next month, guess what? More shares, action, more dividends. And more dividends, backs more shares. And how does this grow? Like a snowball coming down the mountain. Now here's the secret that a lot of people don't realize. Growth is slow at first. You even think, wow, this isn't producing anything. But by the second, third, fifth year, the thing exploded. It's like magic, only it's math. And the most beautiful, you don't need to put in rivers of money at once. What you need is time, patience, and constancy. A little bit every month reinvested can turn into freedom a few years. It's not about getting rich overnight. It's about letting time and compound interest do the heavy lifting for you. Imagine you own several properties, shopping malls, hospitals, office buildings, hotels, distribution centers. But calm down. You don't have to build anything, nor deal with tenants complaining. About the broken sink. Welcome to the world of REITs, which in English means real estate investment trusts. It's like a club. This club buys and manages huge properties. You join this club by buying shares of a REIT on the stock exchange, and every month this club takes the rent from the properties and shares with partners, that is, with you. Simple as that. Want to learn how to make your money work for you? Subscribe to the channel and start your journey to financial independence. Now, why is this so powerful? Because the REITs are required by law to distribute at least 90% of the profit from them to investors. In other words, every month money comes into your account just because you are a member. And here comes the secret. Some REITs pay monthly dividends. That's right. While you sleep, shop, or drink your coffee, your invisible properties are working for you. And you know what's best? You can start small. You don't need to buy an entire building. With $10, $20, $50, you already enter the game. And you can diversify, a little in hospitals, a little in Amazon warehouses, a little in hotels, all in the same portfolio. It's like planting several seeds that bear fruit every month. What if you reinvest those dividends? The snowball we talked about before. It grows even faster. Investing in REITs is one of the simplest and most powerful ways to generate passive income in the US. And the whole world can participate in this, as long as they have access to the American stock exchange. Imagine you bought a chicken. This chicken gives you an egg every day. Cool, huh? Now imagine that in addition to that, over time, the chicken also becomes more valuable. This is exactly what happens when you invest in stocks. There exist two main ways to make money with them. One, dividends, the daily egg. Some companies like Coca-Cola, McDonald's, or Apple share part of their profits with their shareholders. This money that you receive, month to month or quarter to quarter, is the dividing. It's as if the company said, "Hey, thanks for trusting us. Here's your share of the profits. You can use this money however you want. Spend it, save it, or the smartest thing, reinvest." 2. Stock appreciation, the growing chicken. Now let's imagine you bought a share of Amazon for $100. After a few months or years, it becomes worth $150. This growth in share value is what we call appreciation. You don't have to sell to see this money now, but if you do, it's profit straight into your pocket. Why are both important? Dividends are like a passive salary. They give you a predictable income. The appreciation is the growth of your assets. It's what makes you build wealth over time. Think of it this way. Dividends feed the present. Appreciation builds the future. The secret is to find companies or investments that can give you both. An example? You buy shares in a solid company that grows and still pays dividends. As stock prices rise, dividend money is already flowing into your account. It's like having a chicken that grows and still gives you eggs every day. Compound with dividend reinvestment. Imagine you have money invested in a dividend-paying stock. For example, at the end of the year, it gives you $100. Most people would take that money and spend it. But if you do something different and use that money to buy more shares of the same company, the following year, you'll have a little more stock than before. And then, you know what happens? In the next dividend payment, you already receive more than the initial 100. Let's say you now receive 110. You reinvest again, and the following year, you receive even more. And this snowballs year after year. You start small, but if you stay focused and keep reinvesting, your earnings will grow on their own without you having to work harder. This is the power of compound interest. It turns every dollar you earn into a worker who will continue to generate more money for you. This is how people build wealth over time, with consistency, patience, and strategy. So whenever you receive dividends, think carefully before spending them. If you can, reinvest them, because every small amount reinvested today can turn into something much bigger down the road. Now let's talk about a danger that many people don't realize: not investing your money and ending up losing purchasing power due to inflation. Inflation is when things become more expensive over time. For example, today you can buy a chocolate bar for $1, but a year from now it might cost $1.20. If you leave your money sitting in savings or stashed under your mattress, it won't grow, and over time it'll be worth less. This means that even if the nominal value is the same, it buys fewer things. Investing in dividend-paying stocks helps protect your money from this. Why? Because many of these companies increase their dividends over time, keeping pace with or even exceeding inflation. In other words, your money can grow and maintain its real value. It's as if your purchasing power is protected. Therefore, failing to invest is, in practice, letting your money lose value over time. If you want to build extra income through dividends and investments, this channel is for you. Subscribe now and follow every step. Now let's talk about why dividend investing is great for beginners. Investing can seem complicated and even scary, especially if you've never done it before. But the beauty of dividend investing is that it's more relaxed. Dividend-paying companies are usually large, well-established, and don't like to take big risks. They want stability and maintain their profits to continue paying their dividends. This means that the share prices of these companies don't tend to rise and fall wildly, giving you more security. Furthermore, many of these companies have easy-to-understand businesses, such as those that own buildings, stores, or factories, and pay out a portion of the money they earn to those who invest in them. In other words, you don't need to be an expert to get started. It's a calmer, safer way to put your money to work. Now let's talk about how to start investing in dividends, even if you don't have a lot of money. These days, you don't need to save a fortune to get started. Many brokerages allow you to buy small shares of a stock, called fractional shares. This means that even with just $10 a day, you can start investing. And there's more. There are funds called ETFs, which combine several dividend-paying stocks into a single investment. This allows you to diversify your money, meaning you don't depend on just one company, but on several at the same time, which helps reduce risks. So, don't wait until you've saved a lot of money or feel insecure. Start small, with what you can afford, and gradually increase your income. Before you start investing for real, it's important to understand some numbers that help you choose good investments. The first is the dividend yield, which is the percentage of the amount the company pays you in dividends in relation to the share price. For example, if the stock costs $100 and pays $3 per year, the dividend yield is 3%. But be careful. Very high dividends can be a sign of trouble within the company. Don't assume that higher is better. The second number is the payout ratio. It shows how much of the company's profit is being used to pay dividends. If it's too high, like above 70%, it could indicate that the company isn't saving money for growth or debt repayment, and that could be risky. It's also a good idea to look at the company's track record. Has it increased its dividend every year? This is a sign that it's growing and stable. These numbers help you choose stocks that pay dividends safely and will grow over time. Now that you know what numbers to look at, let's talk about the steps to start investing in dividends. First, define your goal. Do you want to earn extra money every month? Or are you thinking about saving for the future, like retirement? Your goal will help you choose the right investments. Second, choose a brokerage to open your account. There are several easy-to-use brokers, such as Fidelity, Schwab, and Vanguard. Third, open your account. It's quick. You can do everything online. You just need to fill in your details. Fourth, choose where to invest. Specific dividend-paying stocks or funds that bring together several of these stocks, called ETFs. Fifth, activate the dividend. reinvestment plan called DRIP. This way, the dividends you receive automatically buy more shares, making your money grow faster. And finally, start small, even if it's just $1. The important thing is to start and be consistent. Now, it is very important to know what not to do to avoid problems with your dividend investment. First common mistake, chasing very high dividends like 10% or more. It may seem like a good deal, but this is usually a sign that the company is in trouble and may cut the payout. Another mistake is to rely solely on a company's past history. Just because it paid dividends for 20 years doesn't mean it will continue to do so. Always check whether the company is healthy today. Also, don't buy stocks just because they're trendy and overpriced. Buying at a high price can result in little return on your money. And finally, don't ignore the company's financial health. If it has too much debt or isn't making a profit, the dividend may disappear. Knowing how to avoid these simple mistakes can save you money and time. Finally, imagine a person named John who decided to invest just $10 a day in dividend-paying stocks and ETFs. With that amount, he invests about $3,650 a year in solid companies that grow and pay dividends regularly. Over time, these investments grow not only due to the value of the shares, but mainly due to the dividends that are reinvested. After 10 years, John's portfolio could be worth around $70,000. After 30 years, this portfolio could reach over $3 million, paying over $30,000 per month in dividends alone. That's the power of compound interest and consistency. Starting small, investing regularly, and reinvesting dividends can turn a simple investment into a real source of income. You've probably heard the famous advice, invest as soon as possible to build wealth and ensure a comfortable retirement. But many people get lost when they try to get started because the world of investing seems complicated, full of difficult terms and confusing options. Today, I'm going to show you a simple and powerful way to invest, dividend investing. And I'll explain it so simply that even those who've never heard of it will understand. So, what are dividends? When a company makes a profit, it may decide to share part of that profit with its shareholders. This portion is called a dividend. It can be cash directly deposited into your account or sometimes additional shares that increase your stake. The beauty of dividends is that you earn money just by owning the stock, even if the market price rises or falls. This provides a stability that many investors appreciate because you don't rely solely on the stock's appreciation to earn. Now comes the secret that really makes your money grow: reinvesting your dividends. This means that instead of spending the money you received, you use that money to buy more shares in the company or fund. This way, you start earning dividends on these new shares, which you bought with your previous dividends. It's like a snowball rolling down a mountain. It starts small, but it grows and grows. Over time, this growth turns into an avalanche of money flowing into your account. But before you go out and buy stocks, there are some numbers you need to know to make smart choices. The first is the dividend yield. It shows how much you receive in dividends compared to the share price. For example, if a stock costs $100 and pays $3 per year in dividends, the dividend yield is 3%. Sounds good, right? But be careful. Very high dividends, like 8%, 10% or more, can be a warning sign. It could mean the company is in trouble and that this high value won't last. Another important number is the payout ratio, which is the percentage of profit a company pays out in dividends. If a company earns $1 per share and pays 70 cents in dividends, the payout ratio is 70%. Generally, a payout ratio below 70% is considered healthy because the company still has money set aside for growth, debt, repayment, and continued growth. It's also important to consider the company's track record. Does it regularly increase its dividends over the years? Companies that do this demonstrate stability and commitment to rewarding their investors. Once you understand these concepts, it's time to plan how to get started. First, define your goal. Do you want extra income for everyday use, or are you thinking long-term to build wealth and ensure your financial freedom? Second, choose a reliable and easy-to-use brokerage, such as Fidelity, Schwab, or Vanguard. You can open an account online. It's quick and easy. Third, choose where to invest. You can buy individual shares of well-known companies that pay strong dividends, or invest in ETFs, which are funds that already group together several stocks and give you greater security through diversification. Fourth, activate DRIP, the automatic dividend reinvestment plan. This way, you don't have to do anything. The dividend money buys more shares on its own. And don't think you need a lot of money to get started. Today, with fractional shares, you can invest as little as $1 and gradually increase your investment. Now, here are some precautions you should take to avoid making mistakes. Don't chase dividends that are too high, as this can be a trap. Never rely solely on a company's past performance. It's important to consider its current health. Avoid overpaying for a stock just because it's trendy, and keep an eye on the financial statement to see if the company is in debt or actually making a profit. If you do this right, even if you invest little, you will see your money grow over the years. For example, if you invest $10 a day without fail and choose good stocks, after 10 years your portfolio could be worth over $70,000. In 30 years, that same portfolio could be worth millions and still pay a high monthly income from dividends alone. This happens because of compound interest, that is, money generating more money, and the discipline of always investing. So, what seems like a small amount at first can turn into something huge in the future, giving you and your family more security and freedom. Investing in dividends is a simple strategy, accessible to anyone, and can transform your financial life without you needing to be a market expert. Investing in dividend-paying stocks is a smart and affordable way to grow your money over time. With patience, discipline, and informed choices, you can build a stable source of income and ensure your financial freedom in the future. Start small, reinvest your dividends, and watch the magic of compound interest transform your investments into prosperity. The important thing is to take the first step today.